The Fed and other central banks have been expanding their balance sheets in order to keep their dual mandate active, price stability and full employment. But based on everything we publicly know at this time, wouldn't it seem more likely that they have other motives? You came here for the truth, so let me unveil that for you. Today we're going to look at the absolute documented facts. We're going to talk about an issue I brought up yesterday's video, inflation or deflation. We're going to be looking at the central bank activities. We're going to talk about what's happening with real estate, what's happening with asset prices, and how this affects you as the individual. Let's go. This article here is talking about the Federal Reserve and what they've been doing. I just want to cover one point really quickly. The Treasury market's weight has shifted around in the past year, meaning the Federal Reserve's $80 billion of monthly purchases no longer fit the way that they're supposed to. A reevaluation of how much the central bank is buying of each maturity is in order, likely in the coming months. So this is coming directly from the Federal Reserve at the high levels. And according to Lori Logan, this is a quote, the Fed will make minor technical adjustments to our purchase sectors and increase the frequency at which we update purchase allocations to remain roughly proportional to supply. Let's make it very clear. This will likely increase the balance sheet, just like when we had the whole repo crisis. You remember that? It's just a technical adjustment. We're not expanding our balance sheet. We are not printing money. This is not quantitative easing. What we are doing is a technical adjustment. It's just, oh my goodness, I can't believe it. But anyway, this is what they're saying right now. We'll see what happens because we don't know until we look at the actual balance sheet to see their activities. We can look at all of the information that is public, and that just the public information gives us more than what we need to realize how sinister these organizations can be. In line with that information, you could see Ms. Logan was addressing how the Fed implements monetary policy by the way of these two key rates. For decades, the Fed primarily has used the market-determined Fed funds rate to influence the economy's momentum to achieve the central bank's maximum employment and stable inflation mandates. As I talked about in the introduction, right? For some time, the high end of the Fed funds rate range has been bounded by a rate the Fed pays deposit-taking banks to park cash on the Fed's books. Another rate, called the reverse repo rate, sets the low end in transactions with eligible investment funds and other financial firms. So they're basically saying that this is going to be something that we think about changing. Okay, so I want to look at these issues, not to get into more detail. I'm going to look at these two things and the way that they change them, if they do, over the next little while, and I will let you know. I'll keep you up to date. That suburban home buyer could be a foreign government. Overseas investors turn to America's single-family rentals. An interesting one that I wanted to discuss real briefly for a moment here. Big foreign investment firms that buy office buildings, hotels, and shopping centers around the world have a new favorite real estate play: single-family homes in American suburbs. So this is quite interesting. There was some activity like this leading up to the whole, subprime crisis and so on. But this one happens to be very interesting. Whenever I see repeating patterns, whenever I see exaggerations, I'm always trying to bring that to you. These institutions are partnering with U.S. housing companies to buy or build rental homes by the thousands. In suburban neighborhoods near cities such as Atlanta, Las Vegas, Phoenix, blocks of families are sending monthly rent checks to ventures backed by Canadian pension funds, European insurers, and Asian or Middle Eastern government-run funds. So this is just something that I think people should be aware of. Where is the money going to? Where's it coming from? And of course, as they always say, follow the money. The reason I mentioned that previous article is simply what happens when you have interest rates at these levels. You get things that are completely out of whack. You get things that have never happened before. You get exaggerations and so on. So I want to talk about real estate. That's leading me into these here. I'll show you some information about Canada. We should talk about the US as well. But take a look. Overall, inflation has not become a bigger concern for Canadians. And of course, nothing has really changed dramatically. Consumers are still having their views on inflation being very muted at this time. Consumers believe that the interest rates will remain low for a very long period of time. That's a fact, according to them, as well as those in the financial industry. That's an important conclusion. Inflation can be a self-fulfilling prophecy. If households and executives anticipate higher costs, they will demand higher prices for goods, services, and labor. The central bank would have to break that cycle by raising interest rates, even if it thought the economy still could benefit from further support. So they are basically suggesting, as the Bank of Canada, they mentioned it here, and all the other central banks, that they want to make it known to the consumer, to the businesses, that interest rates will not be rising. And Bank of Canada, the Fed, and some others have talked about at least through 2023. So imagine that the first interest rate hike, according to what they're saying, according to their plan, which is never a plan, is that until 2024, interest rates will be all the way at zero or close to it. So what does that do to the psychology of the investor? Of course, that's going to have a big impact. I don't need to worry about inflation. I don't need to worry about interest rates going higher. I'm going to take as much risk as I possibly can. My worst performing video in the last probably 5 years at least, was talking about this very topic, looking at the investor psychology and how that affects people. But of course, not a lot of people are interested in that. They're looking for tickers. There's a lot in this article out of better dwelling, but I'm just going to mention a point. Canadian banks have begun to weigh in on new mortgage changes, and they aren't optimistic. Earlier today, the OSFI announced a revision to the uninsured mortgage stress test. The change will shrink supersized mortgage budgets, reducing the number of over-leveraged borrowers. But of course, it's such a small percentage, as they say here. I read through it really quickly. So basically, they're going to shrink it down just a little bit. That's not going to really change anything for the average person. And it's not going to stop the bubble from growing at all. At the bottom, right at the bottom, it says, it had previously, when they tried this, it had some bite on sales, but it didn't move prices at all from their existing path, because the investor knows that they're going to keep low interest rates. That's ultimately where this is. They're going to put pedal to the metal on everything that they've got. They're going to take as much risk as possible. And I understand why. The central bank is telling you that. They're signaling that. And they're making it very clear. Even the biggest banks in Canada are agreeing with this information. Canadian Real Estate, a large Canadian bank, just blamed the Bank of Canada for the property bubble. It's not just one of the banks. I have shown you previously, all the major banks in Canada are saying the Bank of Canada is creating a bubble. I mean, these people, they make money, these businesses make money from this. But of course, this is, there's one side of the business, which is, the analysts and those who you might hear from. And then the other side, who's going to make money from it. So it works separately, but of course, you're going to hear it from all of these different economists and analysts and so on. One of Canada's largest banks attributed the country's frothy real estate market to the central bank. BMO wrote, a surge in demand now set ablaze by the promise of low for very long interest rates. Of course. That's what I was just saying. And BMO, of course, saying the exact same thing. This next portion here is talking about quantitative easing and how essentially you cannot continue this forever. And they use the example, and I thought it was very interesting, of Japan, While QE can help to extend the inefficiency of a frothy market, it doesn't work forever. The only market we have long-term experience attempting to do so is Japan. The country's young people increasingly became economically insecure and led to more people failing to even attempt to live a productive life. Failure to launch became a standard way of living. As for home prices, they fell anyway. By attempting to save home prices, they sacrificed a generation of young people. In the end, the impact on home prices became systemic, failing both young adults and the market. This very well could happen in a place like Canada, where you look at not just the major cities, but now since 2020, the problems are all over the place. And that article says exactly that. It's not just Toronto, Vancouver. This is going on in the small towns and cities as well. But you keep hearing the exact same thing over and over again. It's because of the low supply. It's the low supply, the low supply, the low supply. Check this out. Contrary to the perception out there, new residential listings in Canada rose to a record high in March. Wait a second, what? What? Did I just read that right? Oh, let's go on. The market is indeed drum tight, but look at the chart and decide what looks more out of balance. The denominator, supply being too low, or the numerator, sales being too high. Hint, it's the latter, i.e. the red line surging off the page. By the way, you can go to the link. It'll be in the description. Just basically saying that right here, it's the latter, the red line surging off the page. In fact, on a seasonally adjusted basis, new listings are now running 25% above where they were in early 2020, using 2019 as the baseline. Sales, however, are running almost 75% above that level. We reiterate that this acute surge in demand is exaggerated by massive federal to household transfers, the promise of low for long interest rates, ingrained expectations of price growth, fear of missing out, and likely some speculation. Fantastic quote right there, and it sums it all up perfectly. So what does this mean to you? To you as the investor, to you as the person who's got cash in hand, who's got savings, who's got investments, who's got a pension fund, who's got a 401k. What does this mean to you? Well, of course, you have to understand there's always two sides to it. There's what they're going to tell you, and they, meaning the government, they, meaning the central banks, they're going to tell you that inflation is low, that there's never a problem. The same with the government. Remember, 2007, 8, 9, and 10, all the way through, there was no admission of a problem. So you know that you can't trust them. So you look at the data and you see it for yourself. You see what's happening to the prices around you. But understand that beyond that, these entities don't work for you. These entities work for the big establishment. So they're always going to do the actions that help them out, not you. So you as the individual, you've got to get your finances in order. If you're overextended in one place, maybe it's time to look at where else you can keep and park this savings, this cash, whatever it is, in a place that is maybe undervalued at this time. It's hard to find some of those, but that could be just simply moving from one stock to another. That could be into a different asset class. You have to decide that for yourself, but I think it's really important right now. It is at a critical moment to have a little bit more scrutiny on where your money is being kept. Really interesting charts here. I'm going to move through this really quickly. Bank of America, total loans and deposits. You could see what has been happening since the financial crisis. It was climbing and climbing and climbing, the loans as well as the deposits. And then you see for the last over 10 years at this point now, it's basically been flat in terms of loans. Very interesting. And of course, really since the beginning of 2020, the amount of deposits has been skyrocketing. Citibank, same situation, exactly same situation. Then you've got total bank deposits, looking at the big four, and they have, of course, accelerated. Then you look at the big four bank loans, bank total loans and deposits. overall, same situation. Now that tells you something about what's happening in the banks. It brings up, what came first, what comes first. Is it the loans, or, is it the deposits? What creates what in this fractional reserve world? And this right now could spell a very big problem for these banks in the way that money is created. What will the central bank do in response? We only know in time. That's all for this video. If you found that informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about selling stuff online, I'm talking about buying stuff on Amazon, selling stuff on Amazon. That is an important skill today more than ever before, and you can learn it for free at the AmazonGPS.com. If you want to understand the financial system from top to bottom, A to Z, I've got everything you need to know, and you could find that at the link in the description. And if you haven't seen this video yet, you definitely want to check it out. Click it, and I'll see you there.